Have you ever thought of what would happen if the bank that you use on an everyday basis failed? Like, have you ever questioned if that money is actually secured? You know, I'm sure you heard of the basic slogan, FDIC insurance will cover up to $250,000 if your bank fails. But is that really the case? Like, where does that money even come from? What is the FDIC? That's what I want to break down in this video. So chances are, if you're Gen Z like me, you probably never even had the thought of what would even happen if my bank failed. Because, I mean, we've been alive during times where bank failures aren't really a super rare thing to happen. And I think back to the biggest one I remember were the two banks in 2023, where it was a Silicon Valley Bank and First Republic Bank, right? And what happened during those times, I remember it was big in the news. Those banks simply just got bought out, and so anybody that had money with them didn't lose anything, which, you know, seemed too good to be true. I thought so. So I did a deep dive into the beautiful artificially tailored banking system that we have, but in particular the FDIC, for this video. And as of today, October 2025, there's actually been 2 bank failures that happened just this year alone. But it didn't really make the news or nothing like that. Nothing too big. I didn't see it promoted anywhere. But Silicon Valley Bank and First Republic Bank were started based off of like fear. People, like one rumor about a bank failing, people start going crazy, start getting their money out, and then it kind of led to those 2 banks, you know, going under. But going into the FDIC, so let's just back up a step and talk about that little sign that you see when you walk into probably every bank. That's right, every single bank. That sign, your deposits are FDIC insured, right? So, I mean, most people just look at it, don't think twice about it. But that little sign, literally every door that you walk into a bank, it carries one of the most important promises in the financial system, that if your bank fails, your money is safe. So the FDIC stands for the Federal Deposit Insurance Corporation. It's government backed as a safety net that protects the depositors, basically us, you know, everyday people, so we don't lose our savings when a bank collapses, right? Because it's not rare that it happens, right? Because it does happen. And right now the current insurance limit is $250,000 per depositor per bank, right? So that means if you have less than that in your account, you get it back, you know, no matter what happens to the bank. But FDIC, you know, it isn't just some magic organization, right? It works through a chain that has a lot of parts to it, a lot of complex parts. They try to, you know, make it seem so hard to understand, right? Because you got banks that's involved in it, you got the government, and you got the Federal Reserve, right? Those are all separate. The government is not the Federal Reserve, although that's kind of in its name, federal, but it's not federal because it's private. And a reserve is kind of funny too, because, well, they don't even have any money, right? So just to understand it, we got to walk through how the system works, where the money even comes from, and what are the hidden costs of getting into it. So basically, how the FDIC was created was back in 1933, during the great time of the Great Depression. There was a lot of bank failures that were going on, and this was kind of just common. And now everyday people were literally losing their life savings overnight. These bank runs literally had where crowds of people lined up to get their money out, made the situation 10 times worse because all that fear. And, you know, I mean, if you thought that you were going to lose your money at a bank, you'd probably go try to transfer it out too, right? So what happened was, to restore trust back in the people, the Congress passed the Banking Act of 1933, in which they created the FDIC. So basically how it works, banks don't get the FDIC insurance for free. You know, they pay premiums every year, just kind of how like car owners pay for car insurance, and that money goes into a pool called the DIF, the Deposit Insurance Fund. So they have this system that when a bank fails, the FDIC uses the DIF to pay depositors up to that insurance limit. And now the FDIC doesn't just hand out this cash randomly when it has to pay up. It's actually, they become the receiver of that failed bank, meaning they take over all the bank's assets, operations, stuff like that. So they would normally sell off all the assets, whether they're in the stock market or houses, property, stuff like that. But most of the time, what they've been doing is the FDIC just finds another healthy bank to buy that failed bank's deposits. So customers, we're hardly even noticing the switch. And a lot of it is getting monopolized by these big banks. So these big banks are just buying smaller banks that are failing instead of actually just letting them play out. They take over all the assets, and of course, rich get richer. The big corporation is only expanding. Okay, and this happens without the public even knowing, right? So they'll shut down that bank and have like a private auction. They say they shut down the bank on a Friday. They have a private auction during the weekend, and then on Monday, everything opens up back to normal for customers and stuff like that. So that's when these big banks, you got the JP Morgans and Truist and the top banks, they're in these auctions trying to buy these failed banks. Like, these banks have failed already. So, everyday people, me and you, we're not going to know that this bank has failed because it's already under auction. And if they tell the public that the bank has failed, everybody's going to start to fear and panic. So they hide it from the public until after the fact, once it got bought out. Okay, so there's that. But what if nobody even wants to buy it? What if it doesn't go up to auction? Okay, so that would be when the FDIC has to pay each of the depositors directly from the DIF. So, and here's where it gets tricky, because the size of the deposit fund, the DIF, the Deposit Insurance Fund, it's not huge when you compare it to the total money in the banking system. So as of mid 2025, there was only about $145 billion in that fund, which sounds like a lot, right? But you got to think, US banks, they're holding trillions in deposits. So putting it into perspective, literally if just 1% of bank deposits disappeared in a crisis, the FDIC's entire fund could be wiped out from that. And the fund limit, the bare minimum it has to be is 1.36% of the total deposits. As long as it doesn't go under that, they keep premiums for these banks at a certain amount, right? They say if it gets under 1.36%, then they'll raise premiums, right? But what are these banks even paying is what I wondered. And it's just so conveniently, this isn't public information, right? And this is based off of a guess. So I'm looking at based off of like top banks. They have like this percentage to be able to give you an estimate, but it's not like a hard number, which kind of sucks. But let's just go the biggest one, JP Morgan. So they literally have multi-trillion-dollar assets, and the estimate that it shows to pay every year to the FDIC is 0.9 billion, so 900 million to 1.3 billion dollars per year. And I guess if it gets under that 1.36% at the FDIC, they'll raise premiums all around. But so that's the general estimation that JP Morgan, a $1 trillion company, is paying about $1 billion a year to maintain this fund, which is why the FDIC doesn't just rely on the DIF. because they only have 1.36% of depositors' money actually in that fund. So they say it's actually something bigger that backs that up. And it's a nice little phrase they have, backed by the full faith and credit of the United States government. So how does the government's role play in all this? So if the FDIC doesn't have enough money to cover a wave of, bank failures, then they would call on the Treasury for help. And now the US government guarantees FDIC insurance, which means that depositors will always be paid. So this government backing is what gives people the confidence that, their deposits are truly safe. But of course, the government doesn't just have piles of extra cash sitting around. Everything runs on debt. So they'll have to raise the money either through taxes, and tax revenue, is never going to cover all of federal spending because it's always more than they bring in from taxes. So when, they need more money, the government likes to borrow. And they do this by selling bonds, IOUs, out to anybody, investors, institutions, foreign countries, right? And if that borrowing still isn't enough, well, then the government still has one backup plan to use. And that's the Federal Reserve, right? The Fed, which is the central bank of the United States. And of course, it's not federal in the same sense like other agencies are. And it doesn't hold piles of money in reserves. So the fact that it makes it so powerful is the fact that it can print money out of thin air. Okay. So if the government needs to fund to, get the funds for the FDIC, it can just borrow from the Fed, right? And this Fed is just going to create money electronically and use it to buy government bonds. And then that money would then flow to the FDIC so that it can give depositors their money back. And this system ensures that, no depositor under this $250,000 bracket would lose their money. And then it also creates hidden costs, of course, that are going to show up later. And we've seen it happen in the 2008-2009 era with the whole bank runs, banks loaning out more than they could handle. And, well, what happened? A lot of these banks went under. So what happened in crazy times like that? Well, the first cost is debt. When the government borrowed from the Fed, it's going to have to pay the money back with some interest. So the government pays its bills with taxpayer money, which, that means more tax revenue eventually is going to have to be used for debt payments. And then, well, it's going to leave less money for other things they like to spend on: education, healthcare, infrastructure. And then the second cost, the one that we feel the most, inflation, right? Of course, when new money is created and added to the system, the value of each dollar is going to go down. You can buy less. Prices rise. Savings lose their same purchase power. And then everyday goods are costing us more. Now, depositors aren't going to lose their money directly, right? But the value of that money can shrink over time. So imagine if the Fed or the government or the bank, anybody, took money out of your bank account. Let's just say you have $1,000 in your bank account. They took 20% of that. They took 20% of everybody in order to pay back bills and everything else, right? Oh, the government would be overthrown tomorrow. Everybody would riot. Everybody would protest and everything else. Everybody would lose their cool, right? But what if we just printed more money so that $1,000 that you used to be able to buy goods now only costs $1,200 to buy them same goods? And this inflation, nobody bats an eye at that. And of course, Gen Z, we weren't taught about anything with keeping your money in the bank and inflation and stuff like that. And they try to make it seem so normal, like, oh yeah, you can't just put money under your mattress because, you're going to lose value of it. And we go around like this is normal. Like it's supposed to be this way. And everybody just accepts it. Give us cheap distractions. Yeah, let's just watch the football game. Yeah, let's just scroll TikTok. Yeah, whatever. Right? And we're not batting an eye at this key component. The fact that they can just print money and, nobody's going to bat an eye at it. And I think Gen Z is starting to wake up that the system is corrupt. The system is not for us. So this is just a key indicator, right? So just getting back to why the FDIC matters anyways, right? Because all they're doing is preventing chaos. They're preventing outrage. They're preventing people from going AWOL, right? Because before the FDIC was even created, these bank runs were common. Okay. So just the mere rumor of a bank being in trouble was literally enough to cause a stampede of people lining up to get withdrawals. So, since no bank keeps enough cash to pay everybody out at once, even healthy banks can collapse under panic, right? So this is a way to reduce that panic. And the FDIC pretty much did that. They have deposit insurance, which, people trust that their money's safe, even if the bank fails. So that trust keeps the banking system stable. And without it, modern banking as we know it wouldn't even work. And after the whole pandemic happened in March 2020, there used to be reserves for banks, 10%. They have to hold 10% of depositors' money. But after that, it's down to zero, which honestly is crazy. And we've seen after the 2008, 2009 bank runs that, these big banks are too big to fail. And it's always going to be like this. So this is a valuable lesson for Gen Z, that we know that we can't have too much money saved up in our bank account because, it's just losing money. It's losing value. Okay, that same $1,000 that you put into your bank today, it's not going to be the same in a year. We know this. We need to act on this. Don't hold all that money. Keep your bills. Keep a small emergency fund in your bank, and that's it. Okay, so let's just say that the FDIC, has to pay out for a bank thing. Okay, let's just run that down. So they do insure $250,000 per depositor per bank. Now, Gen Z, we're not, big ballers like that, but it's still nice to know. So if you do have over 250,000, say you're liquid, one, I don't know why, but you probably I think the only people that have that much liquid is probably someone like super wealthy, like hundreds of millions, billions, right? And that's just chump change for them. So, what do? Right? What's their safe route? Sticking with a top bank, which sucks for everyday people like us because you don't want to feed into the system. The safest thing you could do if you have more than that money is put your money into a top 10 bank. Look at what the top 10 banks are by assets. Obviously, JP Morgan Chase is number one. They proved almost 20 years ago that banks are too big to fail. So your money's not going to go anywhere if you're in these top banks. Now, credit unions, small national banks, stuff like that, they could fail. There's been 2 that failed this year, but, of course they got bought out by a bigger bank, and then you're just then you get thrown to a top bank, right? So splitting up your bank accounts would be a good thing. I currently have 4 bank accounts. I recommend people at least getting 2. Split up your money. Don't keep it all in one bank account. Use one central thing. Because even if, you get your money back, but that bank has to freeze the money for a little time, you don't want to end up in that predicament. Okay? Because really can't say never. Never can say never. Okay? So, I also thought, what do these rich people even do? Like, are they seriously holding all this money? Because if you're rich, you pretty much know how the whole finance game works, how this money game works. Well, what they do actually, I seen they buy T-bills. You might have heard of them, treasury bills. Basically, you can buy these bills from the government and you're essentially just lending money to the government, and it's popular for like a short-term savings. Okay, because they mature in 1 year or less. So this isn't, money that you need tomorrow. This isn't bill money, but like if you have extra savings, stuff like that, you can literally buy it out in the future of like a month, 2 month, 3 months, 6 months, 12 months, right? Up to a year. And these short-term treasury bills basically gives you the interest at the end, right? They don't pay you interest along the way, but they give you the big amount at the end. So let's just say you bought $9,700 in T-bills, and then in a year you will receive $10,000. So that $300 difference is your interest for that. And that's my assumption that the super wealthy rich would do to keep their money even safer and make something on top of it than just keeping it straight at like a Chase or Truist or something like that. And really at its core, FDIC insurance is just about trust. Trust is the glue that keeps it all together. The actual money in the fund isn't large enough to even cover the entire system, right? What really keeps people calm is the belief that the US government is going to step in. So that belief is what prevents runs on banks. It's what makes people comfortable leaving money in accounts rather than, keeping it under mattresses and stuff. So the system works because people trust that it's going to work. Plain and simple. Surface level, it doesn't look like we have anything to worry about. Everything's all good. We trust our government, but the cost of the system shows up indirectly, which the majority of people don't even realize, through taxes, through inflation. It's not free. It's just hidden, right? And now, so that's basically the whole runaround with the FDIC. Real quick, credit unions are slightly different. They're not under the FDIC, but they're under the NCUA, the National Credit Union Administration, which is basically their whole spiel of things that is wrapped up same way the FDIC is, in a different name. I mean, it's 250K that's insured as well. So it's basically the whole wraparound, but FDIC I feel is more popular because more people use banks, and banks are way bigger. So that's why I wanted to deep dive into banks. Credit union, yeah, you're still kind of secured as well. But I just wanted to go over all that. So at the end of the day, I'm not saying you got to take all your money out, keep it under the mattress, because the bank's not entirely safe. It is. I mean, I tried looking up studies to where, banks that actually legitimately failed, how quick are these people getting their money back? Are they getting the actual full amount if it's under the 250K, right? Stuff like that's hard to find. But I mean, nowadays, they're literally just getting sold to big banks. So you might not even have to worry about it. You might have a small national bank by you. There's only 4 or 5 branches around the town. And then, next thing you know, next week, now you're signing in to a Chase username, creating that account. Same money still in there, same number, same digits, right? But at the end of the day, don't keep too much in there, right? It's always good to have a small little cushion. Always have your bill money in there. But we have to invest. We have to take it upon ourselves. Gen Z, we can't just store money in the accounts. And I know times are hard. Times isn't as great as they once were, per se. But we have to take accountability with our finances, because at the end of the day, the system's not here to help us, right? We can't just live freely, not thinking about finances because, our government loves us. They'll take care of us. They'll make sure we're all right. No, complete opposite. So this is just my little deep dive. I hope you enjoyed it. I'm out.